If you're just starting to research investing, the first question to answer is why you should even invest in the first place. And getting even more particular, why you should invest in the stock market. The answer becomes increasingly clear when we study the habits of millionaires, people who have already generated great sums of wealth. In a study by Capgemini in 2022 that surveyed nearly 3,000 high net worth individuals on what their investments look like, on average, the millionaires surveyed had 29% of their investments in stocks, 24% just sitting in cash, 18% in fixed income, which are assets like bonds and certificates of deposit. They had 15% of their money in real estate and 14% in alternative and rarer asset classes. While we can see that stocks made up the largest percentage of the assets they owned, the percentage doesn't ultimately matter. The point here is that the rich acquire assets in the first place, something that is expected to generate a return on their money, so they will increase in value in the future. This is the fundamental building block of generating wealth. Luckily for us, it is relatively easy to get started investing in the stock market, although actually being good at investing is a little more challenging. But here we can see the performance of different asset classes over 20 years from 2002 to 2021. REITs performed the best, which are real estate companies trading on the stock market. The second one is emerging markets equity, essentially just companies from second world countries like the BRICS nations, for example. Then the third best performing asset class was the S&P 500, which is a combination of the 500 largest companies in the stock market. They had returns of 9.5% annualized. Depending on what time frame you look at, the S&P 500 averages around an 8 to 10% return per year, which are pretty high returns compared to most asset classes. This is why a lot of millionaires prefer to buy stocks. But what happens if we don't buy assets and we just save our money instead, and we don't do anything with it? The issue that you'll run into is inflation, which is normalized around 2% per year until we've had a large spike recently. As of the recording this video, the annual inflation rate is around 3.7%. As more US dollars are printed and enter the economy, the value of every existing dollar goes down, since we now have more dollars. Supply and demand, right? Inflation eats away at the spending power of the dollars you already have, which is why it seems like everyone can buy fewer and fewer groceries every year. The rich invest to hopefully grow their money and ensure that they outpace the rate that inflation can grow at. Otherwise, it's almost like you're losing money because everything is getting more expensive as time goes on. All this is not to say that achieving high returns in the stock market is easy. The risks include the broader financial system going through hard times, because generally speaking, if the economy is doing poorly, then stocks will as well. But the correlation isn't all that strong. We saw that firsthand during 2020 when the economy was essentially at a standstill and money was still pouring into the stock market. But yes, the performance of the stock market will impact all stocks within it to a varying degree. Another risk is events that occur with any individual company you might buy into. If you choose to invest in individual stocks like Microsoft or Netflix, for example, then anything bad that happens to those companies will obviously hurt their value as well. So those are some examples of ways where things can go poorly. And keep in mind that the returns on that graph of assets I showed you earlier are averages, meaning that there are years where stocks actually lost money overall. So don't get discouraged if you don't immediately start making money. Investing is a long-term game. On average, the more risk you take on, the higher potential returns you could get on your investments. Risk-free bonds like treasuries sold by the US government have very low risk. Actually even better, they have no risk unless the US goes bankrupt. But returns tend to be pretty low. On the opposite side of the risk curve is stocks, especially smaller companies. They tend to be less established, which ups the risk factor, but they also have the highest potential for growth. And where you position yourself on the risk curve here depends on your investment goals and risk tolerance, among other factors. For an example of high risk and high reward, look no further than Tesla. This is Tesla's stock chart. You can see that the value of Tesla has gone from around $15 per share in 2019 to around $400 in 2021. So if you bought Tesla stock in 2019 and held it until 2021, then you would have made approximately 26 times your money. So if you invested $1,000, you would have turned that into $26,000. Well, that sounds nice. Keep in mind that investing in Tesla was very risky back then. Elon Musk himself admitted that the company was on the verge of bankruptcy multiple times. And if that had happened, then the stock would have gone to zero and you would have lost all your money. So while it is possible to make incredible sums of wealth pretty quickly, over the span of just 2 years in Tesla's case, make sure to have realistic expectations going in. Most companies don't perform this well, and especially not that quickly. It also took a lot of risk to make that much money as well. So yeah, if you want to grow wealth over time and provide for those around you, the stock market is one of the best ways to do so. If you'd like to learn more about stocks and how to buy them, this video is a part of a larger playlist on learning how to invest. So if you're interested, check out that playlist in the YouTube cards or description below. And thanks for watching.